Well, hello, everyone. My name is Clément Gignac, Chief Economist with iAIM Financial Group, and welcome to this third edition of iAIM Weekly Fall Series, directly from my home here. So the timing is pretty good this morning because I will present my guests. We are a week from now. It will be the election in US, and clearly it will be something to watch because. We have a lot of uncertainty going on. You can notice today, as we speak, market is declined by 3%. A lot of people are nervous. We have a surging second wave in Europe. In US, it's probably the third wave, to be honest, acceleration, absence of fiscal package. And maybe the election next week could be much closer than we thought. We will talk about that with my guest. So let me introduce my guest, and the topic is a bond market, where to go for safety. And my guest is a senior portfolio manager with iAIM, Alexandre Morin. Alexandre is with us since 2015, but he has 20 years experience. He have different place. In fact, he managed above, correct me if I'm wrong, I think more than 3 billion assets under management. And with Alexandre, it's a fan of tennis, a good player. So if you have question, you will have an answer. It will be quick. So without further introduction, welcome, Alexandre, and you have the floor.
Thank you, Clément. Hi, everybody. Good morning. Yes, it's a pleasure to be with you today to present to you what we are watching in the bond market right now, and where do we invest, for safety and to generate some basis points for your clients. For your info, Clément, the total asset that we manage is 6.6 billion right now. We do our best to take good care about those monies.
Yeah, sorry about that, because I invest in your funds, but you have many clients, not only me. So sorry about that. Go ahead.
No problem. Okay, so without further ado, let's start. So I start obviously with the first slide, which is the total return generated by the bond market over a few years. So if you look at the left, at the chart at the left, you can see that the bond market generated positive return. Either you look at a 1-year period or a 10-year period. And when you look at the right chart, you can see that so far this year we generated 8%. The bond market generated 8% total return, which is a quite extraordinary and not expected, I guess, by a lot of people. We hear the same story over and over again, that the rates are too low, that they must go up, so we should not be invested in the bond market. Again, obviously, this year is a very special year. No one, let's say we were having that webinar last year, and someone would say, "Watch out for 2020, something's big coming, and it's a pandemic." I would have been someone would have told me you're crazy to think about it, but still, 8% total return this year. We can see maybe that the one asset class that was a little bit left behind so far this year is the corporate bond market, for the obvious reason that that we went through tough time, especially during springtime. And so the corporate bond market is generated a total return a little bit less than the whole indices. But we can see from the light blue bars that obviously total return is less during the last 3 months, but still better than in the corporate bond market at 1.34%. It's much better than the 44 basis point generated by the FTSE TMX from July 1st up to September 30th. So if we go at the next page, just we like to have that kind of slide in our team. Obviously, I won't go through it. It's a pretty heavy slide. It's just for, you know, if people want to look back in time and say, oh, what happened since the beginning of the year? What kind of event drove the yields down? So you have it. I just concentrate on the last few months on this chart, but one thing is sure, after falling sharply last winter because of COVID, bond yields right now are moving sideways in a tight interval. I'm using here I would say the world benchmark, which is the 10-year US Treasuries. So it is trading between 60 and 75 basis points since many, many weeks. Right now, this morning, we're trading close to 75 basis points. So a couple points to note in the last few months. We saw that rates going up a little bit since the beginning of September. I guess there's two important reasons. As you are aware, a run never seen before run is being done right now, to create a COVID-19 vaccine, something that may happen in the coming weeks. Let's hope. And the other one also is the negotiation, the going on negotiation about a phase 4 stimulus package in the United States. I think it drove the yields a little bit higher from the low points that we were at in August. And also maybe yes.
So,
yeah.
So I interrupt you, sorry about that. So that's probably the reason, because notice today I'm very surprised that with 3% drop on the market as we speak, the rally is not very significant on the 10-year treasuries. They stuck around 75 basis points, as you mentioned. So it's because people expect a vaccine soon and another fiscal stimulus, because otherwise, when I see the 10-year bond yield in UK at 25 basis points and in Germany minus 60, they have a lot of room to see further decline in the 10-year bond yield.
Yeah, exactly. I think you got it right. The negotiation about a phase 4 stimulus package is still ongoing in the United States. Probably not expecting something for the next few days or weeks. We are in the midst of a very important election. Maybe something will happen only next winter, but obviously if we come with a big fiscal package, it may mean more issuance in the bond market. That may be something that, refrain the 10-year yield to go lower than it is right now. Also, on the opposite, one could say that a vaccine is coming one day, probably a stimulus package is coming another day. In the next few weeks, few months, rates should trade higher because we're going to have way more bond market on the street. But please do not forget here that the Federal Reserve is heavily involved in that market. Keep in mind that the Federal Reserve is buying no less than $80 billion of US Treasuries per month. Add to it 40 billion of mortgage-backed securities for a total of 120 billion. This is big dollars that are going off the streets. So it is a big support for the bond market. The Federal Reserve is doing very important moves since March to support the bond market. So that when you have the positive news combined with the Fed, you probably explain a good portion of why rates are trading in that small and that tight range since a few months now. Then maybe at the next page, we heard a lot of stories about the steepening of the yield curves since the beginning of March. Here's a graph to show it to you. So the red line is the differential between the 30-year and the 5-year points here in Canada. The blue line is the same thing, but in the United States. So yield curve sharply steepened in March. The obvious reason, nobody will be surprised if I told you that the central banks dropping overnight rates close to zero is the main reason that explains that those curve steepen a lot. But also you have to combine it with the fact that government need to borrow a lot of money from the market. They like to borrow in the long term. 5, 10, 30 years, 20 years now, a maturity in the United States. So those two factors explain why those yield curve steepened a lot this year. And we anticipate that it may keep going up, not as fast as we saw year to date, but we should not be surprised to see yield curve keep steepening during the next few months. Maybe now on the other chart here, I've told you before, two reasons why the curve is steepening: the central banks, the overnight rate, and the fact that governments needs to borrow a lot of money is the proof. On the left side, you have the federal budget deficit that is, it's never seen before deficit outside of wartime. So we are close to 18%, 16 to 18% deficit here in Canada. We went as low as 22% in the 40s during wartime. And also we have to know that in Ottawa right now, there seems to be no appetite, to stop those deficits. So we may be that line going down a little bit more. We have exactly the same picture on your right from the United States. Very deep budget deficit in the United States. And I was reading a piece of research a few weeks back looking forward for the budget deficit in the United States, and they were anticipating that the lowest budget deficit in the next 10 years in the United States, if nothing changed, it would be something like $900 billion to $1 trillion. So really the financial situation of the US government is really difficult at this point. A lot of this deficit to anticipate in the coming years.
So you talk about the biggest deficit. I thought you mentioned lowest deficit. So this is what you want to mention, I think. No problem. So without this deficit, Alexandre, and sorry to interrupt you, so you need the central banks very dovish and very active. Otherwise, the bond yield will skyrocket. So probably they have a significant bond purchases and have a huge balance sheet on central banks. I think I've seen a chart on that in your package.
Yes, exactly. So if we go at the next page, so yes, a huge deficit, and obviously I was talking about deficit in Ottawa and Washington, but I could add as well here in Canada the Provincial's deficit. 2 days ago, Éric Girard, our finance minister here in Quebec, mentioned us that we should expect still a 15 billion deficit for the province of Quebec, which is a lot never seen before in dollar terms here in Quebec. So turning to central banks, so we have two charts here that relates to the central bank here in Ottawa. So right now, since March, the Bank of Canada is purchasing no less than 5 billion of government of Canada bonds every week, which is a lot. So that's why you see that red line on your left going up quite sharply. Right now, the Bank of Canada owns no less than 35% of the entire Canadian bond market, federal government bond market. It is much higher than the Federal Reserve. Federal Reserve owns something like 27% of the US Treasuries. But keep in mind that 10 years ago, when we were in the midst of the great financial crisis, here in Canada, we never had to do some quantitative easing as they did in the United States. So this speaks for the fact that the Bank of Canada is doing tremendous big moves. We had an hour ago, the Bank of Canada announced that they may buy a little bit less, something like at least 4 billion a week, but still at this pace. If they keep going, buying from 4 to 5 billion a week for the next 12 months, they will own something like 45 or 50% of the entire bond market here in Canada. So this is, we have to raise, our hands to the Bank of Canada, which is doing a lot of tremendous effort to support the economy here. And if we look at the right, huge deficit combined with a big central bank balance sheet, but it's a little bit surprising to see it, but the bonds that are left on the street, so people like us, let's say the marginal buyers, there is less bonds to buy now than it was before the crisis. So as you can see at the beginning of the year, 500-ish billion were available to be buy, like for people like iAIM or other investment fund managers. Right now, it went down to 495 billion. Someone could say, "Well, it's only 15 billion. Why are you talking about this?" But keep in mind that Ottawa is doing huge deficit, and we will see deficit for many years to come, though. So that is pretty impressive here. Next slide. Obviously, we speak about the bond markets. So when you speak about the bond market, you need to speak a little bit about the inflation, which is an important driver of rates. So as you can see from these two charts, one thing that can be said here is that markets, they are not entirely convinced, that central bank will be able to push the inflation higher on a sustainable basis in the future. If we look at the chart on the left in the United States, officially the central banks is targeting 2% inflation on a long-term basis. When you look at the red line, which is the official measure that the Federal Reserve uses, we have to admit that the goal hasn't been reached quite often. Actually, we are way lower than the target that the Federal Reserve is having. So the market noticed that. And if we look at the right here in Canada, it's a little bit less, we are a little bit less under the famous 2%, but still, we have to acknowledge as well that inflation hasn't been really scary in the next decade or so. So that the market knows it, and that's one of the reasons why the yield are not going much higher these days, except for COVID, obviously. But even in 2018, we haven't saw rates going very, very high at this point in time because inflation is still quite low here. Then on the next page, I'll go to the next few slides will be on specific assets that we like. So the first one is the Provincial segment. So as every spread in the world, Provincial spreads went up quite sharply during COVID time. They went down during summertime, and now they are they are stabilizing. Even though, as I mentioned before, the financing needs are really high from the provincial government. We like the asset class, and one of the reasons is even though deficits are really important in every provinces. If you look at the chart on the right side, you can see that even though we are at approximately half the fiscal year for our provinces. Keep in mind that the fiscal year for Canadian provinces go from April 1st to March 31st of the following year. You can see from the gray bars that most of the provinces are ahead of time as it relates to financing their deficit. So this is pretty important. Even Nova Scotia is over 100%, though they are borrowing for the following year. And if we look here in Quebec, it's 82%, Ontario close to 70%, though financing goes well. And I can give you a specific example. 2 weeks ago, the province of Quebec borrowed money in euros, and they borrowed for a term of 10 years. They borrowed 2.25 billion euros. 1 euro by $1.50 Canadian. So this is the equivalent of 3.5 billion Canadian. Keep in mind that the province of Quebec, every deal they bring to the market is a little bit less than $1 billion. So it's 3 to 4 deals that were done in one day going to in some European countries here. So that is pretty impressive.
So, yeah, it's very impressive when you check that. And provincial bonds, it's an area that people have considered. I know that you have a lot in your portfolio because when you think about that, Ontario, Quebec offer a higher yield than Italy. And to be honest, you have the federal government backstop here in Canada, and the public finance is much better than Italy. So, and you don't have any currency risk to invest abroad. So I
Exactly.
think provincial bonds is a very
Yeah.
nice spot to be currently.
Yeah, exactly. And as you mentioned, the Bank of Canada promised to buy up to 50 billion from April 2020 to April 2021. The market is in great shape. At the pace they are buying right now, the Bank of Canada may do half of what was projected, even though when you look at the curves here on the left, you can see that the market is doing great. And a 30-year Canada bond is yielding right now something, let's say, 1.2%. If you accept to buy the risk of Ontario, which is not that high a risk, you are earned with 90 basis points over that 120 basis point from the federal government. So in a fixed income portfolio, I think you cannot go over that asset class. You need to have one, and we do have our fair share. Next, another asset class that we like is the corporate bond market. As you can see from the chart on the left here, the financing that was done in 2020, so far in 2020, by the investment grade companies in the United States was quite high, never seen before at 1.8 trillion. They borrowed a lot of money because interest rates, as you know, went down quite sharply. So borrowing money for an investment grade company was something that has to be done, and treasurers took advantage of it. So they are, let's say, ahead of pace as it relates to financing. So some projections that we are starting to see in the market is that as it relates for the calendar year 2021, we may see a lot less borrowing from a corporation in the United States. And I'll bring you to the chart on the left. You know, there's the borrowing that is important from a company, but sometimes company borrows because they have a maturity coming. So let's say you borrow $1 billion in the market, but you have a maturity that day of 500 billion. So net, you have 500 billion of new money that was borrowed. So when you look at the yellow bar on the right side, you can see that if the projections for much lower investment grade issuance next year does realize, on a supply net all the redemption, it may be one of the lowest year that we will see next year. So it's going to be as low as it was in 2010, 2011. Combine it with a search for yield because of low interest rate. This is good news for corporate bond market for 2021 so far.
Yeah, it's surprising, eh? When I checked your slide deck yesterday evening, mentioned, oh, is it a mistake? But you explain well, and probably it's because with a lot of uncertainty, the capex company cut in the capex, and in addition, with the Federal Reserve as a backstop on corporate bonds, we have the explanation why the corporate spread has narrowed so much.
And the Fed is acting as a backstop. They don't buy much bonds so far because the market, as you can see, is in great shape. And also, I think there's some surveys that are done with investors from time to time, and people are looking to their CEOs and say, I want you to bring down the debt level of your company. So that may be another explanation why, but still, we are overweight corporate bonds right now in our portfolio, and we think that's the way to go for next year as well.
Yeah, time is running, and sorry I interrupt you a few times here. So is it possible in the next 3-4 minutes maybe to wrap up your view and your positioning, and we open for question? Just a reminder for people, if you want to ask question to Alexandre, go with the chat box. Okay, go ahead.
Okay, so in 2 or 3 minutes. So if we go to the next slide, so the views, basically the views are more of the same that you saw when we did our last webinar at the end of July. So I think it's easy to say here that overnight rates will stay at current level for a pretty long period, and we're not talking month or quarters here, but probably a few years of overnight rate at present level. Rates went up during summertime, the beginning of the fall as well. But keep in mind that central banks are looking at it, and they won't let the very long-term yield go much higher than here, and it would be too dangerous, to choke the fragile recovery that we are in right now. So central banks are watching. If yields go up too quickly, financial conditions because of that tighten, they will act, to make sure that yields don't go up that much. As mentioned before, we think yield curve could steepen further in the coming weeks and months. We like credit. Search for yield is full throttle right now because rates are low. Context of low interest rates, support from central banks, you need to have credit in your portfolios. And also, yes, interest rates are low. A 10-year Canada bonds yields something like 60 basis points here, so it's less than 1%. But when you look at the 10-year German bonds, it yields minus 60%. So on a relative basis, North American interest rates are quite cheap here. So with views come risk. So our next slide, we have the risk here. First and foremost, unfortunately, we have to talk about it, COVID-19. We are in the midst of a second wave coming quickly and sharply bigger, I think, that most of the people were expecting. Some are talking maybe a third wave sometime this winter. Let's hope it won't. It's a prophecy that won't realize, but we have to be cognizant of that. The vaccine, when are we gonna have it? For who? How many doses? Is it going to be effective? So a lot of questions regarding this. In the gray box, the American politics. Focus right now on presidential election, Trump versus Biden. But in American politics, you have to be aware that important elections in the Senate are due on the same day. So that will be important to determine what will be the leeway of the next president of the United States. Is he going to have the both chambers on his side, or it's going to be a split Congress like we are witnessing right now? Keep going on negotiation for fiscal stimulus. Nothing's happening right now. The box in dark blue, so tension, US-China, even if Joe Biden is elected president, I think those tensions will be on the background for many years. Yes, Brexit has been consumed, but the trade agreement hasn't been agreed right now. So this is still a risk, especially for Europe. Tension in the Middle East, something can always happen there and have a big influence on the price of oil, which translate in an impact on the economy. And obviously, without fiscal stimulus, what will be the strength of the economic recovery at the beginning of next year? That is an important question. And lastly, maybe in 30 seconds, our positioning right now as of last Friday. So maybe the message I want people that are with us this morning, listening to that webinar, the message is, if you buy our funds right now, what you will be buying is credit. We have credit, as you can see in the asset allocation, 37% of corporate credit, provincials 36%. Only 12% of federal government. Keep in mind that in the broad benchmark, the weight of that segment is 33%. We like also municipal bonds. We own 6% when there is only 2% in the benchmark. And also there's specific securities that we can buy for active managers, such as mortgages, ETFs, dollar, RB TITs, and stuff like that. So this is a portfolio that is long credit, in every aspect, corporate, provincials, and municipals. So Clément, it's 11:29. So this is the end of my formal presentation. I don't know if you have any questions.
Yeah, we have a lot. Very interesting. And guess what? We will go over time because I interrupt you a few times in addition. So let's say in the next 10 minutes, okay? If it's possible to answer to the question that we have received. So let's start with politics. A week from now, to U.S. election, you have a base case scenario probably, but what can go wrong? And in fact, and could you talk about the the possibility of a Trump election, or at least a contested election, because the early voters seems to be more Biden, but clearly I think the national gap 8-10% in favor of Biden mean nothing. You have to focus on swing state, I believe. Go ahead.
Yeah, exactly. So I bring up a small chart. Actually, it's a clip from the Financial Times from a couple days ago about obviously the national polls. And as people are aware, in the United States, you vote for the electoral college. So if the election was held a couple days ago, Joe Biden would have probably won that election, but it was quite a close call. There's 570 electoral votes to be grabbed by the two contenders on November 3. So if you divide it by 2 plus 1, it's 270 is the threshold to win that election. That is one thing. Obviously, as you mentioned, Clément, national polls seems to be are quite consistent, saying that Biden should win. But under the national polls, you have to be aware of some specifics about some states, battleground states, as we say, that are bear watching next Tuesday. And one that we will be watching is Florida, 29 votes to be grabbed there. I was seeing yesterday from a website called Real Clear Politics that for the first time since many months, Trump seems to have an edge over Joe Biden for the coming election in Florida. 0.4%. This is nothing, razor thin margin. It's a toss-up, actually. But what was surprising me, it was the first time in many months that Trump was leaning ahead of Joe Biden in that specific election in Florida. Also, as people are aware, we hear it in the news, a lot of people have already voted, either in person or through mail. Actually, right now, I was hearing this morning that over 50 million Americans have already voted, which is close, a little bit less than 50% of the entire turnout of the 2016 election. How President Trump he doesn't like the mail-in voting. The fact is there is a lot, and there is some states that are going in Supreme Court right now to have delay in order, to cast all those ballots. I'm referring here to Wisconsin, that we're looking for a 6-day extension period, and it seems that the Supreme Court of the United States wants to provide them with that privilege. So there's a lot of uncertainty.
So it's very important what you have just mentioned, because since the early vote is much bigger than the last election, since it will take days, more than hours, but days, to have all the results, you have a situation that it differs from state to state, that you could have a situation they will not count all the votes, and suddenly if on the evening the election Mr. Trump have a better result than expected, even if Biden at the end of the day everything will win, but you could have a situation that in fact you have a contested election.
Absolutely. And so this is the kind of scenario we're looking at. We think that our baseline scenario is Joe Biden should win at the end the presidential election. Yeah. I think the uncertainty here relates to the Senate. There's a few seats that are up for grab by the Democrats here. We think it's going to be quite a tight contest here, and this is important because if Joe Biden wins and both chambers of the Congress are blue as well, he can do whatever he wants with the American politics. Either it relates to budget, to defense, healthcare, whatever. But if Biden wins the presidential election, but the Senate is split as it is right now, and as Barack Obama went through in the beginning of the 2010s, sometimes it paralyzes the politics in the United States. So as it relates to next Tuesday, we're going to be obviously working all night long. So that is for sure. And there's few products that we can use in case the situation turns sour. We're looking maybe to buy some Japanese yen, which is always a good risk of hedge. We're looking as well to futures on United States Treasuries that can trade 24 hours a day, options on that futures, derivative product related to a credit market. I'm talking about CDX here. So this is the kind of products that we will probably use going into the November 3 election.
So you have a lot of tools, and we will talk much more about that a week from now, because my next guest will be John Parizella, so an expert on the U.S. Politics. It will be next week our guest. So we have to shift topic, because time is running right now. So they have different questions I received here about what does fiscal stimulus push long rates higher with steepening. So the question is a vaccine. If you have a vaccine to be announced, for example, assume that you have a vaccine announced next week. So that will probably provide some hope on the recovery. Mm-hmm. And in fact, that could maybe contribute to have our yield. Correct me if I'm wrong.
Yeah, absolutely.
Except if it's already pricing. I don't know. What is your view?
I think you're right. Obviously, COVID-19 is the most serious risk right now. So the day that a vaccine, effective vaccine, is created, I think it will give probably more importance. You will have to put more probability that the economic recovery will keep going on in 2021. So that will bring yields higher with that scenario. So I think this is fair to say that. But the thing is, if yields may go up, will probably go up at that time. Central banks will be watching. If yields go up too quickly, and then I come back to the famous financial condition, if those increase in yields tighten too much the financial conditions, the Federal Reserve will intervene and say, okay, I will buy more of those longer term bonds, so I will keep a lid on the very long-term yield curve here. So yes, a vaccine will push rates up, but central banks are always watching, and this is one of the reasons as well that we are long credit even going into the election is past the election, because one day it's going to end. One day we will know who will be the president at that time, and one day we will have a COVID-19 vaccine that will be important at that time to be long credit, either corporate or provincial. So we like those asset class, even though we may go through turbulent times in the next few weeks.
So you set the table for the next question, because you have tailwind and you have headwind. The headwind for bonds, if I understood correctly, is a vaccine announcement. So maybe normally they could push bond yield higher, but you have the central banks who are there as well to support the market. So at the end of the day, the question is this one: what kind of total return could investors expect in the next 2-3 years in average per year? Or let's say on average, is it positive return, or we are at risk to have a negative return because interest rate is so low and acceleration of inflation? So how do you see things? And probably you make a distinction between the sovereign bonds, government, and corporate bonds.
Exactly. One thing is we should never say for sure, but this year the bond market, Canadian bond market, generated 8%. I think it's fair to say that we should not see that kind of total return in the next few years. So we think, can we have negative total returns? If we have negative total returns, it's because rates go up, but as well, credit spread will need to go up, which is not our base case right now. So we're going to be surely in the single digit, probably something 0 maybe to 3%, 3% maximum, but honestly, it's going to be far from the 8% that we saw this year so far this year. But expecting sharply negative total return from the bond market in the current situation, I would not say so, Clément.
So, in fact, that will need probably a big shift in central banks, because as long as central banks is there as a backstop corporate bonds and with the QE, and government needs central banks to keep interest rate low to pay all this debt. So I'm very comfortable with what you mentioned. So one last question. Oh, go ahead.
Yes, and maybe one thing also, we have to be cognizant of the fact that the demand for fixed income product is big. You know, in all the those developed nations, people are getting older and older, so they need more revenues than taking the risk of a lot of fluctuation from the stock market. So this is another factor. I think there's a strong demand, systemic strong demand for those kind of product.
Okay, so one last question, maybe a quick answer if you could. So real return bonds, is it a place to be in the portfolio, because it's a different animals, real return bonds in terms of asset class diversification? What is your view, if you can spend 1 minute or two maximum?
Sure. So real return bonds, as we call them here in Canada, and TIPS, which is Treasury Inflation Protected Securities, which is their official names in the United States. So this is one, and maybe we can go a bit further on the slide. I prepared a slide here. So those are tools that are out of benchmarks that we can use when we manage actively a fund. So here, what you see on that chart is the break-even rates. The red one are here in Canada, and the blue one in the United States. What is a break-even? It is the expectation, the embedded expectation of the bond market as it relates to the inflation for the next 10 years. This is the break-even 10 years. So here, the bond market is expecting that here in Canada, in the next 10 years, the inflation rate will be about 1.2%, and in the United States, it's going to be about 1.7%. So as you can see, we are far from the famous 2% that the central banks are looking at right now. Here in Canada, it's lower. One of the reasons is that liquidity in that asset class is pretty dry. This is not a big asset class. In the United States, the Treasury Department issue a lot of tips on a quarterly basis. This is not necessarily the case here in Canada. So we do own some. We like the product. We will buy more if we see those lines going down a little bit. So if those tips and real return bond are a little bit cheaper. Right now, we are invested in the United States, and we prefer that market because this is much liquid than here in Canada. So an asset class we like, we do not have much. And if they go cheaper for whatever reason, a risk of sentiment that keeps dragging on for a few weeks, it's not excluded that we may add more in our portfolios here.
So thank you. Very interesting. So you answered the question, because the topic of this webinar was bond market, where to go for safety. So you provide different avenues. So it was well said, and it was mission accomplished, I would say. Thank you a lot, Alexandre. So my apology for participants, because you have many questions, but we are running short time to answer all of this question. And it's a rendezvous for next week. We will have our special guest, John Parizella. Please notice that we will change the schedule, because it will be, in fact, at 12 rather than 11 o'clock for our next webinar next week with John Parizella, an expert on the U.S. politics. So thank you again, Alexandre, for what you have delivered today. And I wish everybody a very good day. Thank you.
Have a good day.
See you next week. Bye-bye.